Hey everyone, welcome to today's presentation. My name is Clinton. I'm a Forex trader and also a mentor, Forex mentor and coach with Pro Traders Academy, where we offer you professional Forex trading um, and training skills. Okay, so guys, you're welcome to today's training. I'll be taking you through the basics of Forex. The basics of Forex. So many times people wonder what is Forex. Everybody's talking about Forex. What's this whole Forex? What's it about? Basically. All right, quickly let's go through it. Forex simply stands for foreign exchange. It's an abbreviation for foreign exchange. All right. If you are an individual trader, you'll be referred to as a retail trader. And if you're trading this as a professional with some corporate organizations that are set up to do this professionally, you'll be referred to as a professional trader. All right. Retail traders trade from home with their laptop and their devices, and the professional traders also trade with same laptops and computer devices, but they trade from an office setting where they are supervised by some superiors or the management of the company. Okay. Um, if an individual trader, a bank, a government, or a corporation, or a tourist want to travel, definitely they have to exchange one currency for the other. Now, the exchange is that we all know it's usually the physical exchange where you take your um, whatever currency that your country uses to the bank or wherever the exchange is done, bureau the change, and they exchange this money for another. When that is done, you have been involved in foreign exchange. But of course, you did that physically. You did that physically. Now, when we talk about forex exchange, the forex exchange can be done physically, all right, or it can be done online. Now, what we're teaching you right here is not the physical forex exchange. We're talking about um, the online foreign exchange, online trading. That's what this is about. The online exchange, right? All foreign exchange transactions involve two currencies, right? In every instance, one currency is being bought and the other one is being sold simultaneously. That is how forex runs. All right. For instance, you can see here Euro USD. When you're doing a transaction on Euro USD, you're automatically either buying Euro and then selling USD, or you're selling Euro and you're buying USD. That's how it runs. Okay. When it comes to forex trading, the currencies are not traded individually; they're traded as a pair. That's why you have things like Euro USD as a pair. All right. It's traded together. So when you hear forex next time, it simply stands for foreign exchange, exchanging one currency for the other, usually a foreign currency for another local currency. But right here, what we're discussing is not the local foreign exchange. We're talking about the online foreign exchange. It's not the physical foreign exchange. It's the one we do online, also referred to as online trading. All right. Now, talking about the forex market, so many of you already know about the stock market. You know about other forms of investments out there, right? Real estate and the rest of them. Okay. Now, I need you to understand something. All these vehicles of investments can give you certain returns based on how much is involved in this market, how much is transacted in this market daily or annually or monthly or quarterly. Now, I need to understand the forex today remains the largest, most liquid market in the world. Yes, forex is the largest, most liquid market in the world. What do we mean by that? On a daily basis, forex transacts about $5.3 trillion a day. $5.3 trillion a day. Why the New York Stock Exchange, which is one of the biggest stock markets in the world, actually the biggest stock market in the world, transacts about $22 billion per day. So it's nowhere close to Forex. Forex is a big market. It's a big market because everybody operates in this market from all over the world. All over the world. It's an international market. Everybody participates in it. While when you talk about the New York Stock Exchange, you realize that it's mostly the Americans and maybe some of their allies. All right, just like the way you have uh, the stock exchange of other countries around the world. Okay, forex is a global market. It's traded by everybody from all over the world, from different continents, or Europe, Asia, America, Australia, and the rest of them. So, guys, it's a very very, very huge market. $5.3 trillion is what is traded in this market on a daily basis, and it keeps climbing. Yes, that's Forex. So, advantages of trading Forex. Now, the truth is that so many persons will tell you the Forex is very risky, don't get involved, blah 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 blah. Yes, it is, but then there are also a lot of advantages. All right, there's little or no commissions in the Forex market. Commissions vary from broker to broker. You should know that. All right, so sometimes you hear that okay, spread, spread, spread. People will be talking about spread and Forex. That's how the brokers make their commission, and this varies from broker to broker. There is no fixed lot size. What do you mean by lot size? Lot size is like contract size of each of the trades you execute. All right, we have various sizes, and when you get involved in the learning of Forex proper, you get to understand this thing more adequately. You can start Forex trading with as low as $25, depending on the broker you're trading with, or even though we don't recommend this, but it's very possible you start with this amount, but it's not recommended. Low transaction cost, which is called spread. Spread is what you're charged when you transact in the Forex market. All right, this market is open 24 hours a day or 5 days a week. Mondays to Fridays, or actually Sunday night to Friday night. Okay. Then there's what we call leverage. Leverage is what allows you to, go into the market and take great positions. Anytime you come in with $100, you can be given a leverage of 100, 1:100 by your broker, or 1:50. This leverage automatically it gives you the opportunity to take big trade opportunity that you wouldn't have been able to take with your $100 normally. In Forex, you can control large amount of money with small capital. This allows you to keep your risk management tight, and also make nice profit if you know what you're doing. It's highly liquid. All right, the Forex market is highly liquid. You can get in and get out of trade at any time. These are some of the advantages of Forex. All right. And then you have the market hierarchy. I need to understand how the Forex market is structured. All right, the highest set of persons who participate in this market are referred to as the interbank market. All right, these are the guys that set the pace of the market, determine the exchange rates in this market. Then we have the large commercial companies. These companies do do businesses internationally on a constant basis. Therefore, they exchange their currencies all the time. They exchange one currency for the other all the time. So these guys also participate in this market. And then you have the governments, okay? Just like the big commercial companies, governments are moving currencies constantly, sometimes to balance the exchange rate of their country, all right? Sometimes to also prevent inflation and the rest of them. They have central bank, okay? Central banks affect the market as well. When they adjust the interest rate, they also control inflation. They also intervene when they want to readjust their exchange rates. So know that these are the participants in this market. They have spot markets to retail traders and speculators. This is where we belong. We are day traders. We are also people who trade from home, people who trade in small capacity, and then people who are investing, their little money to, help to grow it and have some extra cash. All right. You also have people called the market analysts. These guys are the ones that always try to predict what the market's going to do, what the government are up to, and some of the big banks what they are up to. So these guys try to analyze it and also give feedback on what they expect the market to be doing. Yes. So the major sections in this market, we have four major sections in this market basically. Four major sections. What do we mean by that? The various regions that participate in this market will be London, New York, Sydney, and Tokyo. These sections open at various times. The timing you have here is Eastern time. Eastern time, all right? Of course, you can always convert that to GMT and then reconvert it to your own local time. We have the London time. The London Eastern time starts from 3 a.m. Eastern time. Please note this is Eastern time. This is GMT and closes 12 p.m. All right. They have the New York. New York starts 8 a.m. Eastern time. All right, Eastern Standard Time, and closes 5 p.m. They have the Sydney section. Sydney starts 6 p.m. Eastern Standard Time to 3 a.m. All right, and when it's winter, it starts 4 p.m. Eastern Standard Time to 1 a.m. All right, when it's Tokyo, Tokyo starts 7 p.m. and rounds up 4 a.m. Now I need you to know that this times zones it's relative to these regions across the world because they have the time they rise up from bed and the time they go to work and close. This determines the time their their traders are on their systems trading. Okay, so this timing you have here, it's actually the Eastern Standard Time. I need to know that this same time can be converted to GMT time, and then you apply it to your own location or region so that you know what time the London section is open, the time the New York section is open, the time the Sydney section is open. All right. In our subsequent trainings, we'll be showing you a more detailed breakdown of how this time can be converted to your own local time. In that section, we'll be using the GMT timing to explain it so that you can now break it down to your own local time. Okay. Now, the major currencies traded in this market. The major currencies traded in this market will be those from this very, very powerful economies of the world. Regions like Europe, United States, Canada, Great Britain, Australia, New Zealand, Switzerland, and Japan. These currencies are heavily traded. Why? Because they are major economies of the world. You have euro, you have dollar, you have pound, you have franc, you have yen, all right? And of course, you can see the abbreviation there: euro, USD, CAD, GBP, AUD, NZD, CHF, and JPY. I like you to take note of these currency pairs because you know these are currencies, not currency pairs right now. They have not been paired together. These are individual currencies. And by the time they are paired, you start seeing things like Euro USD, Euro CAD, Euro GBP, Euro AUD, and so on and so forth. All right. Now, this is exactly how currencies are paired or displayed on any trading panel or any trading screen. When you see things like GBP USD, you see a value next to it. The value will be, like, for instance, what you have here is 1.51258. Now, I need you to understand something. The currency on the left is usually referred to as the base currency, while the currency on the right is referred to as the quote currency. What does this mean? It means that 1 GBP is equal to 1.51258 United States dollars. I repeat again, the base currency and the counter currency or quote currency. The base currency is on the one on the left, while the quote currency is the one on the right. Now, what do we have here? GBP USD is equal to 1.51258. This simply means that 1 GBP USD is equal to what? 1 GBP Great Britain pounds actually is equal to 1.51258 US dollars. That's exactly what that means, okay? So take note. It's very important that you know that. Now, we have what we call bid and ask. The bid price is the best available price the broker is willing to buy the base currency for an exchange from an exchanger, and then of course sell it to the market, which in this case is you. All right. Now remember, whenever you place an order, the broker automatically passes that order onto the exchangers. The broker is like the person that intermediates between you and the exchanger. The exchanger is like the big markets, the global market where every transaction is closed or carried out. The brokers are the intermediary persons between us, the retail traders, and of course the big banks or the big market. All right. So the bid, when you hear bid here, bid is the price at which the brokers are able to get for a particular currency, and they're able to sell to you at that rate. Then when you hear the ask price is the price at which the broker will be selling the base currency for in exchange for the quoted currency. Now, these things might be a little bit confusing, but what I need to do after now, you can do a little bit of research on this bid and ask. You will get a clearer picture of what this means. This means that the asked price is the best available price to purchase from the market. Now listen, look at this screenshot here. You will notice that the currency pairs listed here: USD CHF, GBP USD, Euro USD, USD JPY, USD CAD, and so on. And usually two prices are quoted: the bid, the ask, the bid and the ask. So therefore, when you place a buy on USD CHF, automatically the broker would give you this USD CHF at the rate of the bid. Are you seeing it now? All right. If you place a buy on this USD CHF, the brokers automatically places that order for you at this rate, the bid, because that is the exchange rate they are able to get from you on the exchanger's platform. Now, when you want to place a sell, the brokers automatically places that same USDCHF with this price on the ask column. All right? So get that clear. That is how it works. Now, whenever the broker does this placement for you, automatically they take what we call spread. The spread they take is different between the bid and the ask price. The bid and the ask price. Because remember, the broker is like the intermediary person between you and the big market. So whenever you place your trade, they automatically make, sometimes referred to as commission, but it's called spread here in the forex market. Spread, that's different between the bid and the ask price. All right, good. So now we discussed another very important aspect of this forex business or forex trading. It's called PEEP. What is PEEP? PEEP is one language you'll be hearing all the time when you are in this business. PEEP, PIP. This is the unit of measurement to express the change in value between two currencies. Whenever there is a change in price, it's actually measured in PEEP. For instance, you have Euro USD at the current price of 1.2250. When that changes by any digit, it's automatically changing in pips. The change is referred to pips. If it moves by 1 pip, that's when you have things like 1.2251. It has moved, it has stepped up by 1 pip. Sometimes it will drop by 1 pip. So you must learn to understand and speak the language of PEEP, because that is the language you speak in the forex trading business. And as a matter of fact, many other trading options, you'll be hearing PEEPs, PEEPs, PEEPs all the time. Okay, so it's important that you understand what that PEEPs represent. A PEEP is usually the last decimal place of a quotation. Usually, mark the word usually, but not always. Okay, because it depends on the platform you're looking at and how they are quoting or displaying the information you are looking at. Now, let me show you something. For instance, you have here Euro JPY. Euro JPY will be reading 121.716. Then GBP CHF will be reading 1.40148. Now, I need you to note something. When you're talking about pips here, for Euro JPY, the pips is simply this 7 and 1, 71. When the change happens on 1, it means it has increased or decreased by a pip. The third one you see here is referred to as pipette. Pipette is not always of concern to us. We don't talk much about pipette. The third one you see for JPY currency pair, it's not a pip, it's actually a pipette. And when it comes to GBP CHF, any other currency that's not a JPY currency, the fifth one is the pipette. So we start calculating pips from the fourth one. Notice this, we have 1.4014. If there is a change in this last 4 here, whether there's an increase or a decrease in this 4, we're talking about pips. So if this market is to step down by 2 pips, automatically what you're going to get, GBP CHF is going to be reading 1.4012. That would mean it dropped by 2 pips. When it's a JPY pair, Euro JPY, if this currency is to step up by 2 or 3 pips, let's say step up by 5 pips anyways, what you're going to get now is going to be 121.76. Why? Because the 1 here, 71, you'll be adding 5 to it to get 76. If it's to drop by 2 pips, automatically you have 1.21.69. Because what? You're dropping 2 from 71. You have 69. Okay? That's JPY for you. And I've also explained every other thing that is not JPY. You'll be having 4 decimal places to deal with. When it's a JPY, you're interested in the first 2 decimal places after the first 2 digits after the decimal place. All right, That will be explained better in our subsequent classes. All right. So let's get on to the next page. Lot size. Very important that you understand lot size. We have different type of lot sizes. As mentioned earlier when we started this presentation, we told you that Forex is a platform that allows you to choose different sizes of your contract. That simply refers to your lot size. What do we mean by that? When you are placing a trade, whether you're buying or you're selling, or even you're placing what we call pending orders, you have to choose the size of the contract you want to execute or the size of the trade you are placing. Now, what do we mean by that? Each time you execute a trade, for instance, you say you want to buy Euro USD, you need to instruct the broker that you're buying it at a certain size. This size would also automatically translate to how much of your money that will be taken or how much you'll be making when the market goes in your favor. Now we have three types of lot size basically. What you need to do right now is to write them down because you're going to get a deeper explanation of it when we get on to our subsequent trainings. We have micro lot size, mini lot size, and standard lot size. Now a micro lot size, the unit value is actually 0.01. 0.01. That represents micro lot size, and the value in dollars is equivalent of $0.10 per pip. Note that language, per pip. One micro lot is equal to $0.10 per pip. One milli lot, which is also in the writing of it or in the representation of a mini lot, that will be 0.10. That in dollars is equivalent of $1 per pip. For a standard lot, we have it to be 1.0. That's the representation of a standard lot and above, 1.0 and above, of course. And then the value in dollars is $10 per pip. All right. Now, like I said, don't pretend like you understand everything right now. Just take note of everything that we're saying and try to memorize it because you're going to come across this as we progress and you will understand it better as we progress. Okay? It's very important that you memorize it. All right. Now, let's get further. How is money made in Forex? Now, you make money by either buying or selling, basically. Now, when you buy, you automatically expect the market to go up. That means the price at which you bought, you expect it to increase. You expect that currency pair, the price to increase. When it increases, automatically you make money. And when that increase is done, it means there's an increase in the pips. In the pips, remember we mentioned pips earlier. And when you're selling, you automatically expect the price to drop. From the point you enter the market, you expect the price to drop. And when it drops, automatically you make money. Now listen up. If you want to place a trade, you have various platforms to do that. The brokers can provide for you what we call their trading platform. You also have a very popular platform we call the MetaTrader 4. You'll be seeing this in our subsequent trainings and we'll show you how to use this platform to place a buy or to place a sell. Remember, when you place a buy, you're expecting the market to go up. When you place a sell, you're expecting the market to go down. Now, for instance, the screenshot you're seeing here is a situation where somebody who analyzed the market felt that, okay, this market should be going up anytime soon. The person places a buy, the trader places a buy at the bottom here. Automatically, you are hoping that this market should rise. And when it does rise, you can get pips. You can get 20 pips, 30 pips, 40 pips, 100 pips, 200 pips, depending how far the market moves. For instance, in about 7 days, this guy plays this trade, and in about 7 days, this guy made over 533 pips. It's very possible. All right. The same thing happens when it gets to that top, and somebody else's analysis tells him, okay, I think it's time to sell. And when you sell it, you automatically expect it to come down again, maybe by 20 pips, 30 pips, 40 pips, 100 pips, and that automatically will be converted to your money depending on the lot size you applied, whether it's a micro lot size, a mini lot size, or a standard lot size. All right, so let's move on to the next page. Now, three pillars of analysis. When you want to trade, remember you must analyze first. You don't just jump into the market, place a buy, place a sell. You must analyze. And there are three types of analysis basically. Even though you're supposed to be exposed to all this type of analysis, you will end up being a good analyst in a particular area. So you can either be a technical analyst or fundamental analyst or sentimental analyst, but majorly you find more of technical and fundamental analyst. So three types of analysis in forex trading are technical analysis, fundamental analysis, and sentimental analysis. Now, what is technical analysis? Technical analysis simply means the use of various technical tools, the creation of drawing charts, markups, and lines and stuff like that on your trading chart to be able to predict what the market is about to do. Now, they use things like price movement, history, trends, patterns, support and resistance zones. These are various things you see technical analysis analysts use or apply in their prediction of what the market is going to do. Fundamental analyst or fundamental analysis simply involves listening, watching, reading, studying, and understanding news, economical news, social news, political news. These are things that influence the market. These things are very, very strong. They push the market up or down. Economical news, like when there's inflation, when there's poverty, when there is even when there are political issues like fights, wars, and stuff like that, or trade wars and things like that. When there are elections in a country, this affects the currency of a particular country, automatically weakening the value of that currency or strengthening it. This automatically makes that currency a good buy or a good sell. All right, these are fundamental issues, also referred to as fundamental analysis terms. Now we have sentimental analysis. This will be how other traders are reacting to the market. How traders react to the market. It's more feeling, it's driven by feeling, emotions, how they feel about the market, a particular currency, a particular country, a particular region. It could be okay, the US government is making some announcement, Trump is trying to say some things, and the traders just have a feeling that what he's about to say is going to be influencing the market negatively. Even though the news is not out yet, because when the news comes out, you can base it on a fundamental reasoning, not sentimental. Sentimental means you just assumed or presumed that certain things is going to go wrong with a certain currency. It could also be the Brexit talk, because Brexit is always on the news these days. People can stay away from anything that has to do with Great Britain pounds. This sentimental reactions makes the market of GBP, Great Britain pound, either weak or sometimes it could even be strong. Okay, sentimental analysis. So take note again, three types of analysis: technical analysis, fundamental analysis, and sentimental analysis. All right, so let's move on to the last page. Now, the simple trading rules you must know. The rules that will guide you, help you, assist you, support you, and prevent you from losing money in this trading business. 1. Trade on demo until you have a profitable strategy. Yes, trade on demo consistently until you have a profitable strategy. Do not trade when you are stressed emotionally or you are distracted. This trading thing requires some level of concentration, a sound mind, and a relaxed state of mind. You don't want to trade when you're stressed or when you're emotionally distracted, because you are not going to be able to analyze right and get to make a right decision. Stick to one pair in the beginning and gradually expand into other pairs. You can gradually grow from one currency pair to 10 currency pairs and then 20. There are over 45 currency pairs to trade. You grow gradually. Because if you don't pick it gradually, you may end up becoming jack of all trades and not knowing how to really focus and master this whole chart and trading thing. Be patient. Be patient. That's another rule. Very important. Be patient. Be consistent is another rule. Rome wasn't built in a day. You have to be consistent. It's not that you try this today, tomorrow you switch and try something else. Be prepared to lose some trades. You will always lose some trades. You can't win all trades. No failure, no progress. So use your demo and fail as much as you can. When you go on live trading, you become a little bit more confident. Stick to trading on Tuesdays, Wednesdays, and Thursdays. Reasons because Mondays are not always very good. Market is just picking up. Tuesdays, Wednesdays, and Thursdays are some of the best days to trade. Spend 90% of your time studying and 10% executing. Study the charts, study the trading style you're using, learn, expand your methods until you are confident in what you're doing. Then your execution should be just 10 minutes or 10% of your time and effort. And never forget, trading is 90% mental and 10% skill. Mental. That means your mental stability, your emotional strength have to be on point. All right? Thank you guys for tuning into this presentation. I remain your host and your trainer, Clint Mbachu. I am a trader and also a trainer with Pro Traders Academy. It's been a pleasure sharing with you this few insight of mine in Forex trading. I hope to see you in another class. Please feel free to like our page, drop a comment, contact us directly if you want to learn more. We offer one-on-one trainings, we offer group trainings, and we also offer corporate trainings in Forex. Thank you and have a wonderful day.